Lotfi, clearly the action in gilt markets has been concerning, and it captured the attention of many major investors, traders, and bankers out there. When you look across credit markets, where else are you seeing cause for concern and potential vulnerabilities manifesting themselves?
Look, I think if there's one word that describes the relative performance of credit markets this year, particularly in the dollar market, maybe less so in the euro market, but it's resilience. I think we've seen a big repricing higher in yields, but that's been almost entirely driven by the risk-free rate component. As far as spreads go, and that's really the price of credit risk, markets have been very, very well behaved. I mean, the U.S. high yield market, for example, is still trading around 500 basis points, which is barely above the median of the last 2 decades. There's a lot of reasons why I think credit has been well behaved this year. Lack of primary issuance has been one of them. Fundamentally, I think we're going into a period of a slowdown in a position of strength, and I think that's given investors quite a lot of confidence. In terms of pockets of vulnerability, the one thing where we've been focused is really the implications of a higher for longer rates environment, which really means a higher for longer cost of capital environment for firms. I think, as time goes by, we'll get into a situation probably by mid-2023 where a lot of the bonds and a lot of the debt that was issued at a very low coupon will have to be replaced with new debt at a much higher coupon. And I think that means that rate-sensitive balance sheets and low-quality balance sheets, for the lack of a better word, will face a potentially bad combination of much higher cost of capital at a time when actually growth is decelerating. And so the ability to offset higher interest expenses with stronger earnings growth is going to be much more constrained in this cycle, certainly relative to the 2000s or even the mid-90s, which was the last time we had an increase of this magnitude in the cost of capital.
How are you advising your clients to position themselves then in the coming months? Where do you see the opportunity?
I mean, we see really a lot of good value in the very front end of the curve in the U.S. But if you look at high quality investment grade paper from an all-in yield standpoint, we're around 5.5%, and some names even trade at 6%. That is a very good value proposition for total return investors. Away from that, we like pockets of the markets where we feel like the repricing and risk premium has gone far enough that the asymmetry is attractive. Examples would be the agency MBS market, which is trading at historically wide levels relative to treasuries. AAA CLOs are another area. But generically, I think the message has been long good carry, up in quality, and also up in liquidity.